Tuesday, November 25th, 4:19 p.m. New York time. Welcome back, investors, to Winning Wall Street's Money. This is part 2 of 2. So the first part exclusively available only on my Patreon page. Going to look at the current situation with the U.S. economy year to date. Three grids. Each grid is 1 year of history, and each candle represents 1 week. Since it's Tuesday, the current candle is not complete until the close of the market on Friday. Look on the left, that's gold futures. The middle, the US dollar index, and the right is the 10-year US Treasury yield. History, gold is a financial asset, jewelry, and industrial use for thousands of years. I just gave you history. If you don't know, that's a fact. You can fact check that. US dollar has less history than gold. US dollar index, US dollar was not always the worldwide strongest currency. It was the British pound before that. US dollar is the number one currency back in the United States. Even though people might be talking nonsense about it, misinformation for years, is still backed by solid evidence. Many nations, central banks, and non-democracies hold huge quantities of U.S. currencies, bills, the dollar, the 20, the 50, the 100. The far right, 10-year U.S. Treasury yields. Many nations buy U.S. Treasury yields, earning income on those U.S. Treasuries. So right off the bat, again, each of these 1 year. Look at gold, beginning of the year at the bottom left, and look where it is now. Huge bullish run. A lot of this is done by policies, people in leadership position that cause these actions. So again, gold is bullish. This is gold futures. You can also buy a stock ETF, stock symbol GLD. I'm aware there's many financial institutions managed by very wealthy people trying to lure people into investing in their funds that buy gold. You pay fees to them. And the risk is if they go bankruptcy, you can lose all your assets. I highly recommend you, if you're not already, open up a broker that lets you trade equities. One that's licensed, registered, home base in the United States. One that's been around, say, for at least 20 years of history, has living, breathing people you could pick up the phone and speak to or go to an office. Not one that's just social media online. Again, if you don't have thousands of dollars, you could do fractional shares. You find a U.S. broker that lets you do fractional shares. Some let you do as small as $5, $3. Some let you do $10 minimum. Again, you can buy fractional shares of gold, stock ETF, GLD. Whenever you have extra money, if you want to do a contribution, then you buy gold. You don't need to wait till today, tomorrow. If you make a tip tonight, you can make the contribution. Again, dollar cost average, very smart long-term investing. US dollar index, look at that. Top left, the high, and the bottom. Again, the dollar has been very bearish this year. And the far right, the US yields. Look, all this volatility. Top left, the high. Bottom, the low. Yep, back down there again. The current trend this week already broke the low of last week. Trend is down. Yields lower, interest rates lower. So if you buy these, you earn less interest. Again, the middle chart, that current candle is still inside the range of last week. Has to take out the higher low. First, the far left, look at the gold. That current candle broke above the high. So very defined. Gold, second trading of the week, is bullish. And yields, this far right chart, bearish. Show you some history now. Economics, facts. United States Central Bank, aka Federal Reserve. Their last scheduled FOMC meeting, December 10th. That's Wednesday. Wednesday, December 10th. They were going to vote on overnight interest rates between the big financial institution banks. So they either will change or leave them alone. That's what's going to happen on their vote. They also come out with a statement of policy situations after that vote. This, looking at here, is the probabilities of the Fed changing interest rates. So again, the next meeting, 10 December. The current target rate has been 375 to 400. Well, right now, 17.3 are speculating that'll be left unchanged come December. Where 82.7% are speculating they will lower it between 350 and 375. Again, these change throughout the day, throughout the week, throughout the month. They've changed a lot since the last Fed meeting. So right now, the bullish bias is that they will lower interest rates. On to the next. U.S. Treasury Department. Again, one of several federal agencies. They have different durations they auction off of. So I'm going to look here. Again, federal agency, they're closed on holidays. So since January 1st was New Year's Day, they were closed. But when they opened on January 2nd, look here, the 1-year Treasury is 4.17. The 10-year was 4.57. And the 30-year was 4.79. So again, the 1-year expires 1 year from that. So that would be expiring January 2nd, 2026. Well, it was paying less interest first at 10 and the 30. Let's go to the current month, November. Today, the Treasury Department's already closed, but we're going to look at the 1-year, 10-year, 30-year, compare them with. So the 1 year right here, 3.60. It's lower than back on January 2nd. A lot lower. The 10-year closed at 4.01. It's lower than back on January 2nd, which was 4.57. And the 30-year, they closed at 4.67. Back on January 2nd, it was 4.79. So again, they all are lower. So if you purchase them now, if you purchase them before the market close, again, you'd be earning less in interest. Again, they're declining the yields of the interest rates. As well, you can see the longer term one, 30-year, pays a higher interest rate. Let's continue on. Mortgages. 30-year, again, this is from Freddie Mac, big financial institution, Freddie Mac. 30-year mortgage right now showing as 6.3, the average. And the 15-year, 5.53. Again, your mortgage companies would add a few points on top of these, so they make their profits managing the mortgage. So right off the bat, a 30-year, The 15-year, they're about the average rate of the year. Mm-hmm. The highest, the lowest, nope, they're not at those. But again, they certainly could help if they were lower. Let's go to credit cards. Credit card interest rates as of November 19th. The average variable was 19.87. It's very high. That's not good. Let's go look at the health of the bankruptcies. Bankruptcy filing rise 11.5% over previous year. Yep, bankruptcies are worse, higher this year than they were the prior administration. 2025 right here. Businesses over 23,000 filed bankruptcy have gone higher the past several years. Non-businesses also over 519,000 gone higher. If you're familiar with bankruptcies, there's different kinds. Chapter 7, 11, 12, and 13. Chapter 7 has the most. Chapter 13, the second most, followed by Chapter 11, Chapter 12. They have all gone higher. You have politicians that will only tell you positive things, not show you what I'm sharing with you. That's shady what they're doing. It's trashy. FDIC. Not all banks are FDIC. Federally insured. Well, this shows ones that failed to maintain requirements under FDIC. June 27th this year, the one in Texas failed. January 17th, the one in Illinois failed. So 2 big banks this year failed, and they were either auctioned off to other banks, other banks bought them for pennies on the dollar, whatever auction price. So the customers, they're insured as a new financial institution that they merged with, which I could get into all that information. It's public information deep down here, but I'm not taking the time deeper. I've done that before many times. It's aware of the situation. The credit unions this year. Make sure I got to sit. There we go. These are all the credit unions this year. The most recent was November 18th. Pennsylvania. Now, not all these necessarily shut down. Some of them were put on notice and they had to correct their problems or get shut down. Some of them just didn't have the capability to fix their problems, so they merged with other credit unions. And some of them are active, being in a position where they have a certain timeline to fix their problems. So, yeah. So again, we have Pennsylvania, Georgia, Maryland, Illinois, Ohio, Georgia, Jersey, Texas, Ohio. Again, red states, blue states. Several times throughout the year. Look at this, January, March, April. Quite a few of them here during that. And recently, yeah, the credit unions. Again, financial institutions. Not a healthy economy, that a lot of these financial institutions. But again, they are all managed differently on how flexible they are, how much risk they want to take, and how they want to invest the capital they're taking in. The U.S. debt. Over $38 trillion. We're paying only interest on the U.S. debt. So those are 2 negative things that hurt the credibility of the United States, hurt the credibility of the U.S. dollar, hurt the credibility of your treasuries. Only paying the interest. That's a lot. We spend more money than we take in. U.S. debt clock. Show you something here. Interest. I'm looking here from the left. Move over. Interest on the debt. That's a huge dollar amount. Look at that. Just the interest. All that money that could be used for better infrastructure in the United States. But again, it's only interest. Defense is not the largest expense. Neither is Social Security, Medicaid, Medicare. Huge. And also, here on the top, U.S. federal debt to GDP ratio. 1960, it was over 52%. 1980, went lower, 34%. During the millennium, 2000, went higher, 55%. And now, U.S. federal debt to GDP is over 121%. That's a lot of degenerates in leadership positions. It's crazy. That's awful. Yeah, a lot of red. Thank you for always spending just a little time with me. That's it for the video. Thank you for watching.